Hey everyone, welcome back to the channel. Today, I want to talk about how you can strategically use debt to grow your money and advance your financial position. Now, debt often gets a bad reputation for putting people in financially precarious situations. However, when utilized correctly, debt can be an incredible wealth-building tool that even the rich use to their advantage. In this video, I'll be breaking down 7 ways you can properly leverage debt to boost your income, profits, and overall prosperity. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit that subscribe button and click the notification bell right now. Method 1. Real estate. One of the most common ways the wealthy use debt to their benefit is through real estate. Simply put, this allows them to buy more significant assets without needing to tie up large amounts of capital. As their properties increase in value and they pay down their mortgages, they can then leverage that equity to invest in additional properties. This creates a continuous cycle of expanding their cash flow and net worth through properly structured debt. Now, this same real estate strategy can work for your average person as well. As long as you have a steady income, you can qualify for mortgages and begin buying rental properties or fix and flip homes. Just remember to always live below your means and purchase affordable properties to start. Method 2. Leveraged ETFs. Another way to amplify your stock market investments through debt is by utilizing leveraged ETFs or exchange-traded funds. These specially structured funds aim to multiply the daily returns of stock indexes they track, like the NASDAQ or S&P 500. Some funds even use ultra-high leverage, seeking double or triple the gains. So if you invest $10,000 into one of these leveraged ETFs and the market goes up 5% one day, you could see gains around 15% rather than just 5% with a typical fund. However, losses can also be compounded. Overall, though, leveraged ETFs allow regular investors to access extremely juiced-up returns, similar to what hedge fund managers get. Just be careful and do your due diligence beforehand. Method 3. Leveraged company buyouts. Another advanced strategy is getting involved with private equity groups that use debt to conduct leveraged buyouts of entire companies. This works when an investment group borrows large sums of money at low interest rates to purchase a majority stake in a corporation. They then operate the company and use its earnings to pay down their debt. While this strategy seems exclusive to elite investors, some private equity firms raise smaller pools of capital from accredited investors to get involved at a lower level. Method 4. Hedge fund investing. Speaking of exclusive investments, hedge funds are also well known for using insane amounts of leverage, sometimes upwards of 10 times their capital. Top fund managers borrow huge amounts, which lets them make very concentrated bets in markets. When successful, even small market moves can lead to massive percentage returns thanks to leverage. Now, most hedge funds require investors to be accredited and have minimums over 6 figures. However, there are now more retail alternatives opening up that let everyday folks invest in hedge fund-like strategies. Just know that their leveraged nature makes these riskier, so manage positions wisely. Method 5. Margin trading. If you currently have a brokerage account, signing up for margin can allow you to trade with borrowed money from the account provider. Basically, it enhances your buying power so you can purchase more stocks without needing to deposit extra funds. However, you also take on increased risks should investments decline. Used prudently, though, margin trading does offer another way to judiciously utilize debt and enhance your market exposure and profit potential. Method 6. Debt recycling. Here's an important money management concept: debt recycling. This involves redirecting extra income like bonuses or inheritance money to eliminate low-interest debts first. Afterward, you then take out new debt for productive investment purposes rather than consumption. Essentially, you exchange passive debt for active debt that can grow your money rather than simply sitting idle. This can be a great tool for advancing your financial mobility. Method 7. Short selling. The last leverage strategy I'll mention is short selling, which lets you profit when stock values decrease. This works by borrowing shares from a broker and immediately selling them at current market prices. Later, if the share prices fall as you bet, you buy them back at lower rates and return them to the lender. Since you sold them high and rebought low, you get to keep the price difference as profit. This lets you make money as markets decline, which can hedge risks. Accessing capital for new investors. One important question that comes up when discussing ways to utilize debt profitably is how can you access funding for things like real estate investing or hedge funds if you don't already have wealth? While dynamics are changing, most traditional lenders still look for high credit scores, existing assets to leverage, and sizable incomes before approving mortgages or investment loans, especially when you don't have much of a financial track record. However, the good news is that more non-traditional lending options are emerging, specifically catering to aspiring investors with average savings but big drive and potential. For real estate, you can look into transactional funding, wholesaling strategies, or hard money loans, which offer higher leverage based on the deal specifics rather than your financial profile. Terms vary, but it opens doors. You can also increasingly find creative financing for small businesses and startups these days, from zero-interest credit cards, revenue or profit-sharing loans tied to future earnings, and angel investors willing to take risks for equity. Additionally, peer-to-peer lending networks and apps are connecting investors directly with individuals and companies needing debt capital outside the usual credit requirements. Some have delivered exceptional returns. While easier access to aggressive debt instruments does come with higher risk and vetting responsibility, it has the potential to accelerate wealth building if applied judiciously. The key is starting small, testing strategies, and leveraging unique opportunities through up-and-coming fintech platforms rather than only traditional finance systems designed for the affluent. So that sums up 7 ways you can strategically utilize debt to advance your income and investment returns, much like the wealthy do. The key is focusing on good debt, which helps you acquire appreciating assets or grow capital. Minimize consumptive debt, and instead redirect funds into the productive strategies I outlined, like real estate, leveraged investments, and recyclable lending methods. What potential debt strategies resonated most with you from this video? Let me know in the comments. And don't forget to like, subscribe, and hit notifications to see more content like this. Thanks for watching, and I'll see you in the next one.